welcome to this very special edition of The Global View with me, Tanvir Gill. My guest today on the show is a financial historian, the mere mention of whose name will get you to sit up and be all ears. Russell Napier is in town, is in Mumbai, and is in our studios. Thanks very much, Russell, for taking out the time to come here and be a part of this show. Welcome to India. Welcome to Mumbai.
Thank you. It's always good to be back in Mumbai.
Yes, this is your annual visit. I'm given to understand.
It's pretty much an annual visit these days, and it should be more often.
But timely, given the fact that there's so much news flow that is hogging the limelight and making the headlines. I want to start off particularly with the government's big bank recap plan that's been laid out. We're calling it the big PSU bank reset. Whatever you have gathered on this announcement, share with us how you view this development to be able to change or in a meaningful manner improve the health of banks and also get the lending cycle going, which is at a decade low.
Okay, so India has a problem, and this may be a solution to the problem. So let's start with something optimistic. And as we know, we don't know all the terms of this yet, so we have to wait and see. But so what is the problem? Not the problem you might think. So when we think of banks, you think about bank lending, you think of credit, and you think of providing capital to the private sector. The problem India has, it doesn't have enough money. So that's a money issue and not a credit. So every time you think of a bank, you always think of credit. But actually, banks create money. The central bank does not create money. It's the commercial banks that create money. And this capital limitation in the state banks is having a profound impact on the ability of India to create money. So I don't know how many of your viewers are aware of this, but if we take the official number for the growth in broad money in India, it is the lowest level since 1963. Now, in a dynamic economy, 6% is the year-on-year growth rate. Now, we know that's impacted by last year's redenomination of banknotes. We know there's that, but actually it has been profoundly impacted by the lack of capital in the banks. So let's start with the good news. Capital in the banks will be a good thing if and only if it produces a flow of bank credit, because that will create money. And without a pickup in the growth of money in India, I think we have to begin to looking at lower levels of growth. And finally, this is not an Indian problem. This is a global problem. We're looking across the planet, whether it's United States, Europe, Japan, China. We're looking at very low growth in number of money across the world. And it's partially due to this issue of bond finance taking over from bank finance. Now, there's about 150 questions in that one answer.
Oh, absolutely. But I'll take the next question as to you essentially indicating that with this announcement, the government has in a way solved the growth problem, the growth slowdown that we've been seeing over the last one quarter, and that's expected to perhaps be there for a little while. They solved that problem with giving the PSU banks the power to take control of their own destiny.
So potentially, so I'd love to say yes or no. That would be nice, but we don't know all the terms of this yet. But potentially, yes. If this produces enough bank capital to allow the banks to extend their balance sheets, then the answer would be yes, but, and there's the big but. What about the demand for credit? Let's say we fix the banking system. So I think most people would agree with the view that the American banking system has been recapitalized and fixed. However, bank credit growth in America is running annualized this year about 3.5%. Incredibly low number. One has to conclude that that's probably more to do with the demand for credit than the supply of credit. Now, if you walk around Mumbai, it's pretty obvious there's big demand for credit. I mean, there's just no shortage of it in certainly in property and real estate and stuff like that. But I think this is the interesting point. A lot of that credit demand is being satiated by bonds, by the issue of bonds. Now, if I lend you 100,000 rupee, I haven't created any money. I have to have 100,000 rupee to lend you that money. If a bank lends you that money, it creates money. So what we have across the planet is this really interesting dynamic of a great big boom in bond financing, whether it's in Mumbai or Beijing or anywhere else, and really bad bank lending, and that has profound implications for money. So the very simple answer to your question is, perhaps this solves the problem of the supply of bank credit, but we still have this issue of demand for bank credit, and really bad bankers can grow their balance sheet very quickly. What we want is a really good banker to grow their balance sheet really quickly. And that's the key question we don't know the answer to for India yet.
So essentially, when this announcement came, we were also talking about the timing of this announcement, because there is all that talk about the bad loan cycle perhaps hitting its bottom. A lot of the chunky stressed accounts going into the insolvency process, the bankruptcy code being put in place, the Cleanup Act basically taking place to stem the problem. So the risky side of a bank's performance would be taken care of. The flip side is maybe the government is banking on a strong revival in the investment cycle as the stress eases on the one hand. Now, will that happen? Will corporate demand come in? Because this is not, like you said, just a local problem. It's a global problem, and a lot of thought process is being put in this direction as to why there's been such a lag in investment demand.
Yeah, as you say, a global issue. One of those issues is technology, and because of the impact technology is having on physical capital. So I think if you and I were running a corporation and we had a wonderful investment plan that had a 5-year payback period, and we went to our board of directors and said, we have this wonderful thing and it's a 5-year payback period, they would say, how could you possibly know what technology will be like in 5 years? How could you know that? How could you tell me with any certainty there's a 5-year payback on this? I think that is a fundamental reason that we have a lack of investment, because the future is probably more uncertain than it ever has been before. Now, in a growth economy like India, it should be actually less uncertain, because there are so many basic things, obviously infrastructure, that India needs. So actually, if there's anywhere in the world that should be able to kickstart a genuine investment cycle, it should actually be India, because of just the nature of the catch up in so much of the things that have to happen here. So we keep coming back to this issue. Is it a lack of the supply of credit or demand for credit? Well, there's a remarkable thing going on in the world. Debt to GDP is at an all-time high. So you can't say there's no lack of demand for credit. The problem is that credit is flowing into assets. Now, whether it's America, where it's corporations buying back their own equity, or it's people building real estate in Mumbai, it's flowing into asset speculation, and the central bankers have massively encouraged that. The problem with global monetary policy is it's encouraging the speculation on assets, which is a kind of myopic short-term thing, and it is not encouraging long-term investment. There's another problem with that, which is the corporate culture. That's a whole different question. But the key issue is, will we just create more credit flowing into asset prices? Because fundamentally, that isn't good for the economic development.
One more question on this topic, because you've seen PSU Banks rally in a manner that literally signals to the market that there's a turnaround in the corner, just around the corner. Do you believe that things can change very quickly for state-run banks in India because of this massive recapitalization plan? And is the market moving ahead of the curve? Is it jumping the gun in assuming that this will be the issuance that will solve the problem?
So I can see why the market gets excited, because it's looking at cleaning up the existing balance sheet. And of course, that is going to be good for your effective net asset value. We all know there are certain assets in Indian state bank balance sheets that aren't really worth what they say they're worth. So we know that. So this is a good thing. The most important thing for a long-term investor is, will the state banks become better at allocating credit going forward? My view is it's highly unlikely, as long as they're owned by the government. Now, that's an ideological bias to believe that state banks are not particularly good at making truly commercial lending decisions. They're always slightly tainted with an element of politics.
There was one headline that I read that this was perhaps another form of a bailout. Somebody compared this recapitalization plan to the TARP facility that saved US banks during the credit crisis. Do you see that this is more of the same? Just structured in a different manner?
Well, look, as long as you keep the banks within state ownership, they are very likely to continue to make the same mistakes they've made before. The stock market doesn't care about that. It's just focusing on the short-term relief you have on bad assets. So the reason to get really optimistic is when we get the plans and the details of this, is if in some way government control of the banking system was to come down. I mean, there is room now in India for bold moves. You know, the other bits of the economy are doing well. You've got a bond market that can provide credit. There's time now for a bold move on banks. It's incredibly difficult for governments to give up control
Russell,
of banks.
let me ask you, would you be a buyer in PSU Banks in India, just to see?
Look, I'm not a buyer of any equity anywhere in the emerging markets.
If you were to,
I've never owned
put yourself in that
I've
position.
never owned a state bank in my life.
Anywhere in the world?
Anywhere in the world. Now, that doesn't mean to say you can't make money in state banks, because you definitely can, and people just have, and you can trade them. But I don't want to have my capital tied up with what are effectively social projects of the government. You know, I do that with my taxes, and I'm delighted to do that with my taxes, and it's a wonderful thing to do. But I don't want to then take my private capital and align it with how the state wants to allocate capital.
In a troubled banking system, you always see the government coming in, helping the banks, whether these are state-run banks or whether it's the banking sector as a whole, because it's so linked to the core of the economy that the government intervention is important. What we're seeing in the US is the government now stepping back. After the series of QEs, the Fed is now planning the unwinding of its balance sheet and selling off those bonds in the market. The world doesn't seem to be talking about it as a risk factor because markets are rallying. There's still a lot of liquidity in the system, and it's going to be a very measured and calibrated unwinding plan. Should the markets be worried about it?
So what the markets are saying is that the Fed is data-driven and we're data-driven. So let's just watch. If the data is bad, then change your mind. I think that's a pretty reasonable thing to say. Just say, look, what the Fed has taught us is it doesn't know any more than we do. So why be frightened of the Fed? In other words, if the data is bad, the Fed will stop. So my view is that the Fed is going to start unwind and the data is going to be bad. Now, they have, not unwind, but they stopped quantitative easing on 3 occasions before.
Yeah.
First time they stopped quantitative easing, bond yields came down. So they stopped buying bonds and bond yields come down. So what happened? Well, they had to do it again. So they stopped the second time. What happened? Bond yields came down. Third time they stopped it. Now, bond yields initially went up, but today bond yields are below where they were after QE3. So I think what that's telling you is that private capital really sees the central bank as a crutch, as a support. And at least today, it's been very nervous that if that crutch gets taken away, it's been very nervous about growth. Now, I think that's legitimate. I think there is a lot of fake growth in the world because of central banking. So my view is they begin to retreat, albeit slowly. Suddenly, treasury yields are going down, not up, and the central bank gets very worried again. So we have, to some extent, put the global economy on morphine, and I don't think they're going to be taking this morphine away quickly. Now, if you see growth continuing, then fine, equity markets are fine. But I see the growth weakening, and back to something I mentioned earlier.
You see US growth weakening?
Well, I see global growth weakening, which is completely contrarian view of the world, where everyone's focusing on this synchronized global growth. I'm looking at the growth in money. So the Fed can control directly the price of money, but it's supposed to also control the quantity of money. And we now have got broad money growth in dollars of about 5%. Now that is the lowest rate of growth we've seen since 2009. So if we measure, one of the great lessons of financial history, which I like to bore people with over and over again, is that monetary policy is the price of money and the quantity of money. And the growth in the quantity of money in India, you're at 1964 levels. In China, it's at new all-time lows. But even in America, we're back to levels we haven't seen since really just the end of the GFC. So I think this is an indicator that things will not, nominal GDP growth will not be as strong as the market thinks, not be as strong as the Fed thinks, and as the Fed begins to retreat from the bond market, the financial markets will begin to pick that up as they did after QE1, QE2, and QE3.
Do you think the Fed won't be able to go ahead with its unwinding program?
I think it'll start, but I don't think it'll get very far. So I could be wrong on that, but what your viewers need to do is watch bond yields. And I think if you see long-dated bond yields come down, the Fed will, it's data dependent, it will follow everything else. It really doesn't lead. I mean, their job is to lead, but they don't lead anymore. So they will follow.
If bond yields are coming down, and if we do not see the Fed really going ahead with its plan to reduce the risk on its balance sheet, we do not see the Fed, pressing the accelerator on rates, then what gives you the conviction that the dollar is likely to rise from here? You believe that the dollar trade is going to reverse. We've come from 104 down to 92, 91, now we're at about 93, 93 and a half. And you see that trend continuing. You see a strong rebound in the dollar. Yeah,
I do. So I've been one of those strange people who said US rates wouldn't go up very much, but the dollar would go up anyway. Now, kind of one part of that's been right, but the dollar bit's been very wrong. Certainly in the last 12 months, it's come down. Obviously, the dollar is a function of other currencies as well, and we'll probably come on to talk about the yen and talk about the euro, but I see them having fundamental problems, structural problems that America doesn't have. But here's the fundamental reason why the dollar goes up. There is too much debt in the world. The global debt to GDP ratio is at a new all-time high. It's above 2007 levels. We've kind of redistributed debt a little bit, but it's still a record highs. Now, and since 2016, we've had a really rapid boom in debt. So the world is happy. Debt's expanding, and the dollar's going down. But on any occasion I can think of in financial history, where you begin to get the world not adding debt, where even it begins to repay debt, then suddenly the dollar goes up. Because if the whole world had borrowed and we all begin to repay debt, we're net borrowers of dollars. It's the one big currency that's borrowed cross-border. So you kind of, if you believe in a deleveraging coming, which I do, I don't believe there's enough money supply growth in the world to service all the debt, you instantly become a bull on the dollar. Add into that structural problems with the euro and the yen, and the dollar could become a very strong currency again.
Talking about the Eurozone, I remember speaking to you one day after Brexit, and it's been a year and a half since.
Yeah.
Where are we in that story?
So the good news is the world's still spinning around, right?
Yeah, exactly.
The good news is the British economy is still there.
Yeah.
The even better news is we've got even
the
more.
pound is rebound.
We've got even more Indian tourists than we have ever had before. So there are many upsides to Brexit. I think what's happening is that we're beginning very slowly to realise that this is not one against everybody else. That there's not a unified negotiating bloc over here. There are severe schisms within the bloc of Europe. Now that's not good for anybody. People might say, well, isn't it good that United Kingdom's not negotiating against people who are agreed? The problem is that that lack of agreement in Europe is creating problems for the whole of the European economy. So Britain, what can you say? It'll be what it will be, but I think Britain may not leave the euro, or may not leave the European Union. It seems to me that if you listen to the speeches of President Macron in particular, he is saying very categorically that Europe can be multi-speed.
Okay.
Now, there may be room for United Kingdom in a very, very slow speed Europe, but that would seem to be the type of Europe that Poland wants, that the Czech Republic wants, that Slovakia wants, may even be the type of...
you're saying Brexit won't happen?
No, I'm saying there may be a chance in a multi-speed Europe that it won't happen. That's not the same thing saying it won't happen. But I think what we've all got wrong is to think that there's one speed Europe over here and Brexit over here. Now, as it becomes clear that there are more than one speed within the European Union, it is possible that there won't be a Brexit.
Okay.
But remember, David Cameron the Prime Minister asked for certain things ahead of the vote, saying that would really help. These are not dissimilar to the things that Poland is asking for. And actually, some of those things are not dissimilar to things that President Macron has asked for. So post-Brexit, what is really important, that is completely underreported, are the changes in Europe themselves, is the willingness of Europe to go at different speeds. Now, some of them want to go more aggressively quickly, but actually there are many of them who want to slow the whole process down. And within that, perhaps, just perhaps, the United Kingdom has a role in one of those slower.
Japan, with the turn of events, with the Shinzo Abe being reappointed, you're very bullish. You're saying that perhaps after 2 decades or even more, close to 3, Japan could be coming out of its long phase of stagflation.
Yes. I've been saying that for quite some time. At least it's feeding through into the equity market, and the equities have been doing well. There is a breakout coming for Japan, and the data point for that would be the Bank of Japan's balance sheet, which I think will grow more rapidly. The supply of money, which I think will pick up rapidly, and the equity market, which is doing very well in the last several weeks. The fundamental thing that sets Japan apart from any other developed market in the world is it's running out of savings. Many people look at Japan and say, isn't it remarkable how this country for 3 decades has gone with virtually no growth and government debt to GDP going up and up and up and up, and nothing goes wrong. But actually it has finally gone wrong because they've run out of savings. The savings system is so full of JGBs that the Bank of Japan is buying them because nobody else can. And that means it can't stop. And this is the really exciting and frankly in the long run frightening thing, is that if the Bank of Japan can't stop, you really will get aggressive reflation in Japan. It should show up first in a decline in the yen, but in any other economy, where your economy would begin to pick up and when your growth would begin to pick up, your bank balance sheet would contract. But in Japan, where the government's got a fiscal deficit, which even on the best estimate is going to be 4% of GDP, and in my opinion, there's really nothing left in terms of the saving system to buy them, actually, the Bank of Japan's balance sheet could steepen as you get growth. Now, the exchange rate should take a huge hit on that, but that's very positive for the equity market, and actually it does translate into more money growth in Japan, more inflation in Japan. And it's probably the thing that people expect the least is Japan to finally succeed on reflation.
Yeah.
And I think it's just tantalizingly close to it.
No, but a weaker yen of 150 against the dollar, I mean, that would make Japan be dominant in the export market and grab a big percentage of global trade.
So I've lived through that before. So the Asian economic crisis, people forget there's many causes for that crisis. And not all of them relate to Japan. But the yen got to, I think, 145. It had started in early 1994 at 80. It was basically from 95 at 100, got to 145. And that decline in the yen and the impact that it's had, as you've just told us the impact it has in terms of competitiveness, had really negative impacts for the whole of the emerging markets. And I think we're about to relive that again. And this
in
time,
2018, I mean, 150 is by when?
yeah, because it's a thing that
Can
will
I
happen.
hold you to it?
Yeah,
I mean, 150 in 2018?
yeah.
Yeah, okay.
It's a thing that happens very quickly. So let me explain why it happens very quickly again. If Japan begins to reflate, first of all, that will be a surprise. But the thing that would be a real surprise is a central bank balance sheet that expands into the reflation. That would be scary. So, you know, it's not often that you can make these bold, dangerous forecasts on exchange rates. But this is going to be unique because across the world, assuming that growth was doing okay, other central bank balance sheets would not be expanding, and they would be seen to be a different.
What would this do for taking away market share from other emerging markets who are also grappling for a dominant pie in the export market? I mean, we've seen emerging market currencies come off over the last 18 months. The rupee now has also started reversing its trend after being markedly resilient. You know, India is also trying to garner its position in the export market by having a competitive currency. With a weaker yen at a level of 150 to the dollar in about 6 to 8 months' time from now, you know, all of that would change. All of that would just take away one more source of growth for the high growth emerging markets like India and China.
That's why I'm not optimistic on the world per se. There's many other reasons as well we've discussed, but that is the fundamental reason. Yes, it's good for Japan. Yes, it's reflationary for Japan. But as I mentioned, it did cause or was part of the Asian economic crisis last time around. What people who are watching this program have to remember is that trade directly links into monetary policy. To the extent that you manage the exchange rate, and India has got a more flexible exchange rate than most people, but China clearly has not got a very flexible exchange rate. And if you have a stable exchange rate and your trade account or your current account deteriorates, that will produce tighter monetary policy, assuming that capital flows didn't change during that period. So the reason that these movements in exchange rates seem to have really amplified effects on emerging markets is because this actually changes domestic monetary policy. And therefore, we're talking about a tightening of monetary policy in emerging markets or major devaluations. And I should say that I do believe that probably the most important consequence from a fall in the yen is ultimately it will produce a significant fall in the renminbi. Now that has an even bigger effect on the world if and when it comes.
And it's been almost now 9 years since the crisis. Is the party coming to an end come 2018? Are we closer towards the end of the euphoria that world markets are enjoying?
Yes, and I said that in 2017.
Yes, okay.
I said that last year, so, but yes. There's lots of reasons why I would change my mind, but fundamentally we need to see more growth in money and not so much growth in debt. And that's what is ultimately taking us back to another crisis. So if the data points change, I have to change my mind, but at the minute, the growth in money is really worryingly low relative to the growth in debt, so I'm happy to stay with a view that ultimately we pay a price for this. And if the growth in money booms and we can pay all this interest and back all this principal, then it's time to change the opinion. But the data doesn't suggest that.
So be cautious into 2018 is your big message.
Well, I think be very cautious. The political ramifications of the GFC probably only really hit us in 2018.
All right, Russell, we'll leave it at that. Thanks very much for taking out the time, and thanks very much for being here in our studios. Enjoy the rest of your trip in India, and hopefully I'll catch up with you when the yen hits 150. I'll have a phone conversation with you from across the United Kingdom. Thanks very much for being here.
Thank you.